The economic landscape has undergone a radical shift, and the high interest rates are causing businesses that were able to operate over the last few decades to now face serious challenges in staying afloat. Today, I will tell you about zombie businesses, how they have proliferated in recent decades, and why they pose a risk to the stock market, the banking system, and the economy as a whole, as they now confront their imminent disappearance. Zombie businesses are companies that, despite being in operation, do not generate enough revenue to cover their operating costs and therefore must increasingly rely on a combination of debt and equity to survive. These businesses are named as such because, despite being dead in terms of future prospects, they remain alive in terms of their operations. However, they are always on the brink of disappearing, either because they deplete their savings in the form of equity, fail to attract money from new investors, or are unable to secure new loans in the market or through banks. The past few decades have witnessed a significant proliferation of such companies, largely due to government intervention. On one hand, this is through near-zero interest rates that have made money extremely abundant and loans easy to obtain and cheap in terms of interest. On the other hand, it is also due to subsidies, protectionism, and other forms of assistance to companies, especially during the 2020 pandemic. While it was fair for companies unable to operate due to government policies to receive aid to avoid closure, many businesses teetering on the edge of disappearance even before the pandemic managed to prolong their existence thanks to this assistance. Estimates of the number of these companies vary from 10% to 40% in the U.S. According to the Federal Reserve, around 10% of publicly traded companies are considered zombie firms, approximately 18% of all companies according to Wharton School research, and up to 40% according to Credit Risk Monitor, which uses the strictest criteria and looks at the ability of companies to pay their interest with their profits before taxes and interest. However, it is crucial to distinguish between a new and growing company, which often exhibits several of these characteristics, and zombie businesses, which lack growth prospects, investment opportunities, and positive future outlooks. And although both types of companies have been greatly affected by the economic changes of the past 2 years, especially the increase in interest rates leading to greater capital scarcity, higher interest costs, and increased opportunity costs, growing companies have a higher likelihood of survival and attracting public attention, while zombie businesses have very limited survival chances, especially due to the change in opportunity cost. While before an investor might find that the only shares of cheap companies were those of this type that were going through serious difficulties and choose not to leave their money uninvested or earning close to zero interest in fixed income, now things are different. Treasury bonds pay 5% without risk, with high liquidity and without complications, becoming more interesting options than these companies. On the other hand, banks now charge higher interest rates and have higher costs for obtaining capital, so they are more cautious when granting loans. This makes it difficult for a company that could previously increase its debt levels steadily without a problem, to now face difficulties in doing so. However, just because it is more difficult does not mean it is impossible, and many of these companies continue to receive new loans, in what is becoming a problem for the entire economy. Zombie companies can become a significant problem depending on their prevalence in the economy, and it shouldn't be surprising to anyone why. They utilize resources that could be employed by society in more profitable activities, including investor capital that could go into innovation or growing companies, and human talent that could contribute to profitable and efficient enterprises. On the other hand, these types of companies distort the values of stock market indices. Because these companies are part of these indices, they receive a significant influx of funds from indexed funds and pension funds. In part, this is how they can survive. By having sufficient demand for their shares, they can create new shares, sell them at relatively high prices, and continue to obtain capital to operate. Therefore, an additional reason explaining the proliferation of these companies is, of course, the rise of passive investment in ETFs and indexed funds. And while investors like Warren Buffett and Charlie Munger have recommended such investments as the most advisable for the majority, this is not a universally shared opinion. Individuals such as Michael Burry, Peter Lynch, Bill Ackman, and Peter Schiff have warned of a bubble in these indices, precisely due to companies trading at high prices that are nothing more than undead or zombie companies. The third reason explaining why these types of companies can be a problem for the economy is related to the banking system, which, as you may recall, has faced a crisis in various parts of the world this year, especially in the United States due to unrealized losses in their portfolios. This is because bonds have fallen in price due to rising interest rates, leaving banks with unrealized losses exceeding $550 billion. These losses are not a serious problem as long as the banks hold onto these bonds until maturity. However, events like bank runs and similar situations have forced them to realize these losses, reducing their capital, and in some cases, disappearing. And as you might have guessed by now, these unrealized losses are not the only type. Many of these banks have in their assets the loans they have made to zombie companies, avoiding categorizing them as unpayable debts and, by extension, as losses. Often, they contribute to the cycle by lending more to these companies to recover the amount borrowed. For these reasons, analysts are concerned about these types of companies. There are also historical reasons, with Japan's lost decade being associated with the proliferation of zombie companies, thanks to the artificial support they received from the Bank of Japan and the government. But part of the change in the economy includes the impossibility of governments rescuing these types of companies. This is due to an increase in the fiscal deficit, debt, and the fact that their cost has risen, making it practically impossible, both fiscally and politically, for countries to continue aiding zombie firms. Because of all this, the apocalypse of zombie companies has begun, but it remains to be seen whether it will be an apocalypse only for them or if they will drag down the stock market, banks, and the economy in general. Regarding this, I would like to know your opinion. Do you think these types of companies have proliferated too much, or are they a very small part of the economy to be relevant? Share your thoughts in the comments. And if you want to learn more about the trend that encapsulates everything happening in the global economy, I recommend watching the video on the end of globalization next.